I greet you, our viewers. Welcome back to Investment Conversation hosted here on Wealth Money TV. This is the second section, and we are set. Welcome back, Dorothy.
Thank you very much.
Thank you. Now, Dorothy, let me ask you, what is good amount for investment? Is there an ideal amount?
No, Japheth, every time someone asks me about investments, they keep telling me, I'm waiting for the big money to come, then I'll invest. But I think one thing we need to understand is there's no such thing as big money. You can start from where you are. If you look at the different asset classes that I've talked about, look at equities. You can buy a Safaricom share for 13 shillings. That means, what does that tell you? You can put in any amount of money, because there's no day that it will get to that big money that you're waiting for and say, now I am set. I will start investing. It will never get there. So that means, what am I saying? The little that you have, you can start from there.
Okay.
Yes.
The little that you have. Now, let's begin from the little. Ochieng Kimani earns a salary and has some disposable income of around 10,000, and they're looking at starting the investment journey. How do they practically put their foot down and start?
So before even we speak about investments, I think the thing that we need to learn as Kenyans and even as East Africa at large is really savings. Because I mean, so many people have not really gotten to the point of consistently saving on a monthly basis. And I know between me and you, we will always say that we don't have the money.
Sure.
Whatever that you're receiving on a monthly basis is not even enough to settle your own bills. So where is the money to save? But normally when you look at why are we not saving as a people, is because, one, we are living way above our means. If you look at our income and our expenditure, that's where the mismatch is. So what do we need to do? One, it has to be, you have to do what we call budgeting. And the budgeting is not what we do in our heads. Because I know what normally happens is you budget everything in your head, all your expenses. It's always good to write it down. Write down exactly how much you spend on what on a monthly basis. Then from there, you can be able to tell, what is this thing that I can do away with? It's not a need, it's a want. Okay? Then after that, once you strip off, then you'll have that extra amount to keep into saving. The rule of the thumb is at least save 15% of your gross amount on a monthly basis. So once you start saving the 10,000 disposable income, what is 15% of your 10,000? That's where you need to start. Don't start big. It will grow to that big, but you can always start small. So put your 1,500, again, don't save under your mattress. It is not going to earn a return. And that means inflation will eat into your money. So put it in a vehicle that allows you to save that minimal, and it's giving you a return. Then on a monthly basis, as you continue filling that bucket, you'll get to a point where now you can now move to the next asset class. And by that, you move also now to your legacy assets. So saving starts with you, and it can start with any amount of money, and it can start at any time. It's never late to start saving.
Before we even answer the question by Ochieng on 10,000, you brought in an important aspect of 15%. There are those who say, I contribute towards pension, my employer contributes, is NSSF. So does it form part of the 15%?
Yes, it does. In fact, that's why I say now, for those who are privileged to have a pension scheme, so you'll find, let's say your employer puts in, not even your employer, you as an employee, you put in 7.5% of your salary into a pension scheme. So if you minus the 7.5, it means how much do you have remaining? 7.5 only. If you do 7.5% of your monthly salary, you'll find the figure is now even more manageable. So whatever the deductions that are being done, please don't look at what the employer is putting in as well. Look at your contribution to the pension scheme. If it's 10%, it means I have to go.
Yes.
And it means that if I get to my 15%, you can even go up and above. Yes?
Yeah.
If you're doing what you call additional voluntary contribution, that's even better, because it means that you're building your 15% and you can even go all the way to 20%, which by that time we say that even when you retire, then you'll have what you call a good replacement ratio.
Yeah.
Thank you.
Good. Back to Ocheng Kimani.
Back to Kimani.
Yes.
10,000 disposable income.
Yes.
Yeah. So again, what I said is that 10,000, whatever small, just look at the 1,500 on a monthly basis.
Yes.
And I've said, don't put it in the mattress. Don't put it in again in a vehicle where I can easily go and pull it out.
Yes.
Understand yourself. You know, when you talk about saving and investments, you are also a risk to your own investments.
Correct.
How are you a risk? If I put the money in a bank, in case of an emergency, small emergency, what will happen? I'll quickly go to the machine, to the wall, and just withdraw the money. So again, save yourself from yourself. Put it in a vehicle whereby it's not easily accessible. That's why I talked about fix it in a bank, okay? Do what with the unit trust that we're talking about. Look at a vehicle whereby it's not easy. I mean, insurance companies have all these products. Look at the product and see which one really suits me, and then you can be able to invest.
So even as you're balancing your liquidity, you should not be too liquid. That's what you're saying?
Correct. You should not be too liquid, because it means the only part of your portfolio that should be very liquid is what you're using now. Anything that is up and above should be locked in an investment vehicle. Yes.
Good. So the 10,000 they can put in a bank, they can put where else?
They can put in a unit trust. I mean, unit trusts have gained so much popularity in this country, and you can put your unit trust and work it as a bank deposit, whereby I'll give my money, I'll be putting in on a monthly basis, because they allow you also to build up your portfolio.
Yes.
You can even be withdrawing as and when you want the money, because it's a very liquid asset. And at the end of every month, they'll give you a statement that will show you exactly what return you've earned for that period of time.
Wow.
Yes.
Thank you. Talk about Mugambi Mjomba, Toka Mombasa. He has his 500,000 lump sum, and he's looking at, I want to diversify my portfolio. He's 45 years. Walk with him the journey.
Good. So Mugambi here is 45 years. That's
Yes.
the first thing that we need to look at.
Yes.
So that means he has a few, not really a few years, he has some 15 years or so to retire.
Yes.
So he has an investment horizon of 15 years. Then if he has the 500,000 as a lump sum, where do you put? We want to diversify as well. So two ways that we can look at it. Number one is we can do the actual direct investments ourselves in the different asset classes that we've talked about. If I split, normally what we'll do is, of course, we'll come down and say at what percentage do I want to put in one asset class, okay? If you want a balanced one, then of course a higher percentage will be in fixed income, or what you call treasury bills and treasury bonds and bank deposits. Then the rest we can try and earn a return from it and now put into the equities. So what Mugambi can do is, one, he can be able to go to the NSC. First, open a CDSC account, because of course you can't invest in equities without a CDSC account. So you can just approach any broker in the market. They can open for you a CDSC account. Then they can even guide you in terms of the investments and the equities that you can buy. Then of course you can just purchase what is listed in the NSC. But again, for equities, let it be guided by a financial advisor. Exactly, because it is what we call a risky asset, okay? Then, of course, the bulk of the money, we can put it in conservative asset class, whereby now, again, we can just diversify in it, whereby we can have part of the money invest in government bonds. Again, how do you invest in a government security? You can open a CDS account via central bank, and then after that, you can be able to trade your bonds, you can be able to buy your bonds. And if you don't want to do the direct investments, you can do what you call mutual funds, such that you can be able to invest in an equity fund. So a fund that already invests in equities, so that you're not also taking the risk of buying XYZ share. So you can invest in an equity fund whereby it's a collective and they've already invested in the shares, or you can do also a balanced fund, a fixed income fund, whereby they've already invested in the bonds.
Yes.
Yes.
Good. Joki Nafula,
Yes.
She's just been given her retirement dues.
Correct.
And she has a lump sum of 2 million. She's looking at making good use of that money. Advise her.
This is the one, the money that she'll be paid?
Yes.
That goes into your account?
Yes.
The cash lump sum?
Yes.
So, Njoki, 2 million is what she's receiving in her account.
Yes.
So one thing Njoki needs to think about is, number one, what is the plan? What is the goal? Do I want this money? What do I want to do this money with? So most of the time, what we advise people who've retired and they've been given that cash lump sum is put it into good use. One thing is, I think so many retirees, they go into businesses. And most of the time, I mean, a survey was done by the regulator, Retirement Benefits Authority, and you'll find most of those businesses collapse even before 1 year goes.
Yeah.
So really, I think for business, it's a good thing, but where we need to put a lot of emphasis is ensure that what you're doing is something that you've done over the years in terms of business. Don't retire and go and buy a matatu. And you have no idea how a matatu works.
Yes.
Because it only means that, of course, that will collapse. Yeah? And you'll have lost your money. And you can see such a business, again, is capital intensive.
Yes.
So what you need to do is think about financial assets. Yeah? If you can purchase a government security. Remember what I said again, at retirement we need cash flow.
Yes.
And we've said that if I purchase a government security, it means after every 6 months I'll be getting interest in my account. Think about the unit trust. Again, it's not as illiquid as a government security, and it will give you interest on a monthly basis. In fact, for a unit trust, because again, also unit trusts are invested in government securities, but unit trusts help you to have a consistent monthly return. You can even ensure that you can be able to pull out the interest that you've earned for that month, and you can equate it to a salary that you used to receive when you're working.
Wow.
So it's all about knowing what exactly am I looking for, then where do I want to deploy my money into it.
That is it. We wrap up the second session, but again, remember the third session is coming and it is so heavy. Stay on and let's continue with the conversation.